Hello, welcome to the European Open briefing for Thursday, December the 21st. I'm Rafi Boyajan, currency analyst at xm.com, and we're going to be taking a look at what's happening in the currency markets today. So we are seeing a bit of a muted response to the US tax plan, which completed its passage through Congress yesterday. We are seeing slightly firmer dollar on the back of higher US yields. The main impact has been on the bond market. Equities, though, we already been seeing US stocks making strong gains throughout the year. So there wasn't much response on the stock market on Wall Street. The Japanese yen is broadly weaker this morning after the Bank of Japan pledged to maintain its easy monetary policy path. The euro is also benefiting from higher yields. It's up against its major peers, although we do have regional elections in Catalonia later today, which might lead to some volatility for the single currency. And we had better than expected GDP numbers out of New Zealand this morning, which boosted the Kiwi. But let's begin first with the dollar. We can see dollar yen has been rising for much of the week. We can see it's currently trading just below its peak of 113.63 a short while ago. We can see though the dollar index, in contrast, has been steadily declining this week. It actually hit a 2-week low of 93.16 yesterday before rebounding slightly to around 93.38 at the moment. Looking at the 10-year yields on US Treasury notes, they hit a fresh 9-month high of 2.504%. So that's the first time it's broken above 2.50 level since March. So that comes on the back of the tax plan. So we saw the tax plan being approved in the Senate on Tuesday, but it required a revote in the House of Representatives due to a procedural issue, and as expected, the House passed the bill. So now it means that all that's required is for President Trump to sign the legislation, which could happen next week or possibly in early January. There are mixed reviews as to what will be the impact of the tax cuts. But it will potentially lead to a stronger dollar in the short term, at least, assuming, of course, there are no other factors that could lead to a sell-off in the dollar. Let's move on to the yen now, because we had the Bank of Japan policy meeting earlier today. There was some speculation as to whether or not the Bank of Japan will signal that it will soon start to tighten policy, but that wasn't the case. We saw a speech in November by the Governor Kuroda about the reversal rate, which is the rate at which lower interest rates would start hurting the economy rather than benefiting the economy. Kuroda said that was just about he was only referring to it as in the context of an academic study, and it was not an indication of a change in policy thinking. And he said that even though the economy in Japan is doing very well, and in fact, the Bank of Japan raised its outlook on Japanese consumption, capital expenditure, and industrial output. He did say that Bank of Japan isn't targeting growth. Its main goal is inflation. So as far as inflation is concerned, there's still some while to go before the Bank of Japan would start shifting its policy stance, and said that it's going to maintain its yield curve target around at around 0% and interest rates at minus 0.1%. So apart from falling against the dollar, the yen is also down against the euro and the pound. Euro yen actually hit a 2-year high of 134.88. Pound yen is moving back up towards November's 2.5-year high of 153.41. Let's move on to sticking actually to euro and the pound, but versus the US dollar this time. We can see the euro is holding fairly firm just below $1.19. Yesterday it briefly spiked to 1.1901. That's a near 3-week high. We are seeing a spike in German 10-year bond yields. So that came after the German government said that it would be issuing long-term government bonds, plus also the rise in US yields is also boosting other major government bond yields globally. But we do have regional elections in Catalonia, in Spain. Expectations are that there's going to be a hung parliament there. However, if we were to see a stronger than expected showing for the separatist parties there, that could mean further trouble, further escalation of tensions between the Catalonian government and the central Spanish government. Although last time round the impact on the euro was fairly limited. And looking at the pound, we can see the pound is currently trading below its 21 period exponential moving average. It's been fairly neutral this week, though the bias at the moment is to the downside. We had worse than expected consumer confidence numbers out of the GfK survey, whose index fell to a 4-year low. We also had a cabinet resignation. The First Minister Damien Green was forced to resign for misleading Parliament. So there is the pound is fairly mixed, but pressured against the dollar and the euro at the moment. We had GDP numbers out of New Zealand this morning. The economy grew by a stronger than expected 0.6% versus forecast of 0.5%. The annual rate came in at 2.7% versus expectations of 2.3%. That big difference was mainly due to the higher than expected growth both in third quarter as well as upward revision to prior quarters. We can see the Kiwi is trading just below the 0.70 level. It briefly rose above that handle soon after the data before heading back down again. Looking at the details of the GDP numbers, we saw a strong construction sector during the quarter, following weakness in the prior quarters, but the dairy industry didn't do so well due to poor weather and lower prices. That could again weigh on growth in the fourth quarter. So that rebound we saw in the Kiwi looks like it has lost a bit of momentum, and at the moment that doesn't seem to be especially given the stronger, broadly stronger US dollar. The Kiwi might struggle to head back up again. And quick look at the Canadian dollar, because we do have inflation and retail sales numbers out of Canada later today, which could lead to some movements in the loonie. Yesterday we saw stronger than expected wholesale trade numbers for October. That helped the loonie move away from 5-month lows we saw back on Tuesday when USD CAD rose to 1.2918. So that's actually the 50% retracement of the down leg, this year's downtrend for USD CAD. A break above that level would be a bearish signal for the loonie, unless of course we were to see strong numbers out for inflation and retail sales later today. That would boost expectations of a Bank of Canada rate hike, and that would definitely be positive for the loonie. And finally, looking at commodities, we can see gold prices actually managed to rise to 2-week high, hitting $1,268.26 an ounce. That was mainly driven by a seasonal demand, but if we do see further rise in US yields and a stronger US dollar, that could weigh on gold prices. But nevertheless, that recent uptrend is impressive given what's been happening with the US tax plans, which overall should be negative for safe havens. And finally, oil prices. Yesterday, we had the weekly report by the U.S. Energy Department. We saw U.S. output coming close to reaching 10 million barrels per day in the past week. However, that was offset by a bigger than expected drop in U.S. crude inventories, the continued outage in the North Sea pipeline, and we're seeing reports that OPEC, non-OPEC compliance reached 122% in November. A figure above 100% means that OPEC, non-OPEC, the alliance cut output by more than required. So that's boosting prices at the moment. WTI is currently trading at a more than 1 week high of $58 a barrel. And looking at today's economic calendar, the main data this morning will be the GDP, the final estimate in the United States, the Canadian numbers, and the Eurozone Flash Consumer Confidence Index. That's it from me. Thank you very much for watching and have a great day.